Let's talk a little bit about what exactly it means when we look at the S&P 500 and see the pullback that we've seen just over the course of the last couple of months. Are we finding any kind of support here anytime soon?
Hi, Don. Thanks a lot for having me. Well, S&P 500 is in a downtrend until proven otherwise, but I think there is a reason to believe we could have another rally attempt like you just mentioned. Number one, we're right back in that pocket of 4,100, 4,200 area where we saw rallies happen over the last few months, right? In late January to late February, we had rallies of 11% and 8%. Secondly, we're coming off that 2% down week, which is relatively rare. If you go back to 2018, it's happened 30 times now. 21 of the last 29 times it was up the next week with an average move of 1.7%. And third, March seasonality sometimes supports a mid-month to late-month rally attempt as well. So you put that all together, and it sets up an opportunity to have a rally again. Now, the issue has been that each of these rallies have been faded. So until we break that downtrend, I think we have to really treat a lot of these with a grain of salt.
All right, so Frank, that's what we're kind of showing right here, this level, right? This kind of 4,000 to 4,150 range. We're right in this area of support, so you think it actually could hold?
I do, and you can see that below that, if it doesn't hold, there's a big air pocket down below. And so we didn't have the chart there, but there's a big, what's called a head and shoulders topping pattern out there that's been a risk now for the past few weeks that has held. So has to hold again, or else that we can see downside momentum pick up even more.
All right, Frank, now with the focus this week, not just on stocks, but on rates for sure, given the Fed meeting and what's expected to be a 25 basis point hike to short-term Fed funds rates. Can we talk a little bit about what the rates outlook is for the 10-year especially? It seems to be one that a lot of folks are focusing on right now.
That's right. In terms of patterns, right, a classic breakout was when we saw the 1.7 area, a 10-year yield break through that earlier this year, and we quite quickly got to 2%. And I think that's when expectations for all these continued rate hikes really ramped up. And over the last few weeks, it's come in, it's held 1.7 again and back up. So it shows that even though we're probably going to get higher rates over the long term, it's probably going to be a little slower than they were originally anticipated. And I think the Fed is looking at this, right? You want to take this relatively slowly. I think it's presumptuous to really say we're going to have so many hikes without even understanding how the market is going to digest even the first one, right? From an equity perspective and from an economy perspective.
All right, so we're kind of showing things, again, that bottoming out that we saw kind of around that 1.2, 1.25% range for the 10-year, and then again kind of a little bit higher at that 1.35, 1.4% range, and then kind of where we are sitting right now, just about 2.08. You actually do feel as though there's that little bit of uncertainty, but is there a good target that we could see happen in say, the coming months, given what we know right now?
Sure. Well, in terms of the 10-year yield, we just take a measured move from that very large bottom information and gets it to about 225. So you definitely see a working higher from there.
All right, so 225, the last trade that we can see there in terms of the overall target. And then lastly, we want to take a look at what's happening with the clear outperformer, arguably since the pandemic lows, and that's been the energy trade versus the rest of the stock market overall. Do we think that energy is still a compelling story? Do we think it's still worth buying right now?
I do. And one of the reasons is that, this trade has been with us for quite some time. One way to look at this, if you look at the October 20 lows and you compare the XLE energy ETF to the XLK technology ETF, and over that time frame, again, not even including this year so far, XLE was up 90% versus technology 50%. So you're talking about a near double even before that performance gap was widened this year. And in terms of the technicals, you can look at the XLE, crude oil, any one of the other ETFs, and they're in a very distinct uptrend. And even with the parabolic moves we saw the last few weeks and then back down, all that did was bring, say, the XLE back down to that upper sloping channel. So that seems to be a very strong trend. We have to respect it. And it's been in place for a year and a half. And I think until that breaks, we have to respect it and also believe that inflation will be with us for a while.
All right, Frank, I'm just showing it right now. We talked about the performance gaps right now, kind of between technology and energy. You can see they've widened out at certain points, narrowed a little bit over the course of the middle part of last year, and then heading into this year as well, kind of narrowing a bit. So you think that could actually widen out a little bit more?
It definitely could. And at the very least, we want to look at stocks and areas that are in uptrends. XLE energy definitely is one of them.